So we're going to move quickly to mortgage refinance demand surging 27% as interest rates drop for the third straight week. Now, this one's got a little bit of dust on it. This from last week, but I brought it up for a reason. Back to the whole life situation, the life event thing. How many times this year have we talked about people getting to the end of the year and needing money? Yeah. And they need money in December. And I pulled this specifically because these are numbers that are from November. So these numbers in here reflect November over November numbers, week over week numbers, and it's exactly what we're talking about. We're at the end of the year, we're going to see people tap their house for money because they need it, whether it's paying off expenses, buying something big, consolidating debt, whatever it is. And here we go. I mean, when's the last time you saw mortgage rate demand surge 27%? Like, August maybe. When rates plummeted.
August, September.
Okay, so 5 months ago. But guess what? This is why it's important for me to talk about this one today with you guys and for the audience. Is there was a reason back then financially for because the rates were there. Well, we don't have the rates here. Then what's causing this? The demand and the need.
Correct. Absolutely.
So
absolutely.
What do you make of this?
Well, it's getting to the end of the season, the most, the highest spending seasons of the year. So a lot of people that have been carrying balances on their their credit cards, they got to find more space to put on the Christmas spendings or just, to get through the year. So I know a few clients. I got one client that we were helped out, and they're going to be closing next week, and they cashed out, refinance, paid half of their debt, and basically they're happy going into next year, missing 2 payments because of the fact that they were too high in all their credit card payments. Yeah. And it's unfortunate, but, they have that ability to tap into their house, and they've used it plenty of times to be able to, get out of debt. So I think, it's like you said, it's the need. They get to the point where it's like, I don't have any other option but to.
Then you have a lot of people that are just like to keep up with the Joneses, you know what I mean?
Yeah.
And so they're going to go at it and, hey, let me just tap in. So again, there's nothing wrong with what you do. You just got to know how you're doing it. You have to have a strategy behind it. It's like something like, what is it? Just to pay off everything, and then what are you going to do? Are you going to just kind of follow the same trend, or are you going to get out of that trend and really make a difference, for yourself financially and your family? So
I had several motives for bringing this up today with you guys. Number one was, this is what we've been talking about. So there's a little bit of a validator for us. Like, hey, we've been saying this for a long time. The house for some people is going to be their savior in 2024, and it may be in the end of the year, maybe in whatever. And also because this whole, the quarters shifted, the summer felt like spring, fall felt like summer, winter's feeling like fall. And so some of that, I think, is what we see here. But that's part one. The other part is that, it's evidence that, no matter whatever else the market might be doing, when someone needs help and the house is there to help them, they're going to do it. The other thing is that you have purchase applications up 4% higher week over week, year over year. So if you had them higher this year than you did last year, that to me, that signals a psychological shift.
Yeah.
Preparedness. So psychology has changed. Number one, people have an appetite for buying. 2, preparedness. They're getting ready. And number 3, they're doing exactly what we're trying to tell people to do right now. If you're looking to buy a house in the new year, start right now. That starts by putting your purchase application in. And I guarantee you, people that have their purchase apps in right now, they're not closing before Christmas.
Yeah, exactly.
They're closing after Christmas.
Oh, yeah.
But they took their first step before Christmas, before New Year, and even in this evidence, in this data set, probably right before Thanksgiving, actually, if I'm being super honest about when this was originated. So I think this, again, is people listening to what we've been saying for months.
Yeah, exactly.
No,
exactly.
and I had some good friends just this last week. They messaged me and they're like, hey, we started going and seeing houses, during the weekend. We've actually been doing it for over a month since Thanksgiving. And I'm like, oh, okay. Why didn't you guys call me sooner? They're like, well, we didn't know how to start the process. So we actually have a few questions for you. And they're like, okay, well, is it FHA rate? Is the FHA loan better from your conventional? And I'm like, well, how'd you guys start the process? We went on Google. We started researching everything, and then kind of you just went out there and started doing what we read and kind of got information on. But then it got to the point where it's like, okay, I don't understand this. I don't get what this means. So my buddy Michael, he came last week. Yeah. He's like, hey, me and my fiance are trying to buy a house. We started looking at houses. We have a realtor, but when do you think it's the right time to run my credit and actually do the full force? So I'm like, well, it's towards the end of the year, but if you want to strike when the iron's hot, you got to get ready as soon as possible, because what's going to happen is things will slow down for a few weeks going into the new year. But then as soon as they pick back up, what if you see a property you like and then you're not pre-approved, you're pre-qualified, and you try to submit an offer, but it takes too long to get that pre-approval, and now you're a little bit out. Now, if you're pre-approved beforehand, you're already, your credit's already looked at, your income's already looked at, your assets already looked at, so you can maneuver a lot quicker. So they sent in their application literally this morning, and they're like, okay, thank you for letting me know. But still, they started the process by just reading stuff online, getting ready online, and then once they were ready for the actual, like, hey, now I can't take it further than this, then they reached out. But I was like, you want to get ready the soonest possible, because then you have all this time to pivot and make corrections if you have to.
And I'm glad that they do that kind of work, like go in there and Google it first. And then once you meet with your lender, it'll all break down, like it'll make more sense, right? Because you're going to read that now, you can actually put the puzzle together. So I like that.
It's cool because they read it beforehand before understanding it, and then it's easier to put together than telling them up front what it is, and then they have to go research it, and it still doesn't make sense. At least they come with the prior knowledge of, like, I read this at least before.
No, you get a lot of aha moments at that time. Right?
That's what that means. PMI. Okay, cool.
Exactly.
Okay.
Yeah.
So,
and this is the right time for people to ask those questions. I mean, mortgage refinancing, I know this was like refinance demand. You're talking about a purchase situation, but they're to me, it indicates the same thing. Like, people need to take action. What is the reason? What's upstream of that action? It's either a desire or a need. And I think that we're going to see a lot more of this in 2025.
Yeah. And here's a lot of things with people that own homes and refinance. They kind of see the refinance like, man, I'm going to have to do it again. Right. People don't understand, in different countries like Canada, they pretty much they don't have a 30-year mortgage.
Fixed. Yeah.
They don't have 30-year fixed mortgages. Yeah. The highest they have, I want to say, is like a 15-year.
I don't know.
It's a 10-year. It's a 10-year.
Yeah.
Right? And so the average person that owns a home in Canada refinances every 3 to 4 years.
Wow.
It's just what it is.
Wow.
Because their payments are so high. I mean, like, they have to, exactly. It's,
and I think
it's not a bad thing if you plan it correctly.
For us, that whole 2020 through 2022, I mean, that was such an anomaly. I mean, locking 15-year loans at 1.99 and VA loans at 2.25. Like, I don't know what would happen that we would find ourselves back in that place again. It is such a asterisk on the, like, history charts of rates that, that what we've seen these last couple of years, I don't want to say is normal, because it's also been the adverse effect of having that, because we have so many people with the lock-in effect and they're not moving and they love their rate and whatever. But I think that where we're kind of going towards of these extremes, that we're going to find our way somewhere in that middle space of that, not because it just sounds good.
Yeah.
But I think that's just, this is a push and pull effect. Like, we have an affordability problem still broadly for most people.
Exactly.
I
like to bring up that if the numbers work now, do it now. We have, how many clients did we not have that, I see rates are 5.25. They didn't refinance. But they had a 6.25, 6.5, and they're like,
and now it's back.
We think rates are gonna go down, so we're just gonna wait.
Yeah.
And I just kept thinking that, but I didn't want to sound like that typical salesperson, right?
Yeah.
I didn't want to sound like that.
That's the stereotype. He's just trying to sell me on the loan.
But here's what a lot of us, it took me years to understand that. Listen, rates are reflected with the unemployment. Everything's about unemployment. Even though we've seen the Fed funds rate be reduced because of inflation, because of unemployment, things won't change.
Right.
It's not going to change. We saw unemployment go up this time around. And so what's going to happen? Is it tomorrow when the Fed meets?
Yeah. It's today. It's on Wednesday.
Oh, yeah.
It's on Wednesday. Yeah.
So it'll be they're predicting 90% that they're going to reduce the Fed funds rate.
Yeah.
Why? Because they're going to have to, in order to keep unemployment balanced.
Yeah. You already saw the European Central Bank go ahead of our Fed, and they already did that last week.
They already did that. But is that going to reduce our interest rates? No, because our inflation is also higher than anticipated.
They're still fighting that.
So we're
teeter-tot.
They're teeter-totting. The government doesn't know. Our Uncle Powell, they're trying to figure it out, guys.
They have to go figure it out over here. No.
Correct.
Come back, figure it over here.
So I currently have a client right now that we're helping. He's like, he tells me last week, I think I'm going to put a pause on it and wait till rates go down. I go, wait a minute. This is a cash out VA. You already, paid for an appraisal. We're already paid for a termite inspection. We're ready.
Oh, dude.
We're ready, right? And so I told him, don't make a decision now. Let me break it down for you. So you know how we do. We have the mortgage accelerator calculator. I broke everything down for him. paying off $69,000 of his debt. He's getting $107,000. $10,000 of that is closing costs, impounds, etc. So he's gonna get around. I calculate around $96,000, $69,000 to pay off debt, which equates to $1,600 and change. Okay,
in monthly savings.
And yes, and one of them is an installment loan, and the other 3 are credit cards. So where do you know those credit cards are gonna be higher? The installment is like 36. I want to say 36,000 or 33,000. Anyways, we already know the average time to pay off a credit card is 8 to 13 years.
Yeah.
We already know that, right? Because the credit companies, they're going to charge you minimum payments.
Yeah.
They're going to charge you minimum payments.
Most people will only pay that.
Right? So the payment increased by $800 and change for getting that $100,000, right?
So his payment went up by $800, but he's saving $1,600, so he's still net $800 a month.
So I put it on the mortgage accelerator. If we apply that 800, and let's say your interest rate doesn't change for 30 years, and we apply that savings, that 800 that you're already used to, and you apply it to build back your equity by applying that 800 towards your principal on a monthly basis, guess how many years we pay off the house?
7 years early?
It's actually pretty close. 9 years early. 21 years. Guess how much in interest he would save by just doing that?
Probably $135,000.
$341,000.
$340. Well, I guess I didn't know what the loan amount was.
Right?
I was just like shooting the shot in the dark right there. So
yeah.
Wow.
So the numbers make sense. So I broke everything down. I sent the email. I'm waiting for a response, but I think it's great. And then remember, in 8 months, we could revisit the VA IRRRLs.
Yeah. The IRRRL. Yeah. If that does end up happening,
you skip the 2 months, right? And then you get your impound money back.
And I'm following your math here.
$1,000.
And I did $96,000 minus the $69,000 payoff. He still has around $27,000 cash in his pocket, right?
Plus
is that about right?
Yeah, correct.
Plus the 2 months of payments.
He's like 37 and another 5,000 because they just played their. So it's like
impound account.
And he wanted to do some home improvement. So that's enough.
Wow, that's a lot.
Enough. That's enough.
I mean, $800 a month is a big deal. Net positive, even after having paid off all that debt, paying $69,000 debt. Yes, adding $107,000 loan, but having 27 cash in your pocket, rattling around. That's a big deal.
It is.
So,
it is.
So hold on. Given all this that you've told us, what was the linchpin? They just didn't want to because of the rate?
They think the rate's going to go down, right? When we started the refi, we were looking at 5.875 and we locked in at 6.25 and no cost to him.
Okay. No cost to the borrower.
Buying rates, no buying nothing. You know what I mean? No buying the rate down or anything. Just get it right there. Save the money, put that in your pocket, right? Versus buying down the rate.
Okay.
So.
Wow, that's incredible. I mean, so this right now that you're telling me, this is like that microcosm of why you see this number. So when we come on here and we tell you, oh, mortgage rates or mortgage demand for refinance is up 10%, or people go, why? Why would anyone want to refinance? Because the rates are da-da. It's not always about the rate. It's not always about the rate.
Yes, correct. It makes sense. So don't, that whole cliche, don't marry the rate, marry the home.
Yeah, date the
or
rate.
Date the rate and marry the home, and like however you want to spin it.
Yeah.
It's what it is. If things work out, so I get it, things work out, they work out. The numbers are there.
Yeah.
Make sure that you understand how you can apply that. Again, we'll be more than happy to share the mortgage seller calculator. If you're going through this, I don't care what state you're in, we'll give it to you. Just ask for it.
Give it to everybody. Mortgage accelerator calculator. Wow, $345,000.
$341,000. I remember it good because I wrote that yesterday. I put everything together.
Oh man! Wow.
And again,
what a good story.
We take time to do all these things because you care. You want to put them in a position where they're going to succeed.
Yeah.
I know they have a child. It's like, dude, $800. You know what that can actually do?
Yeah.
Even if you don't apply it back to your mortgage, you can invest that in your son's college or whatever.
Save it, and then 529 plan, put it in the market. Like you could do all sorts of things.
There's so many things of how you can make money on your own money.
And that's what I've been telling clients, like, don't wait till you hit a home run with the rates and they tank. Like, take the stairs down, every single 6 to 8 months. If it makes sense, go ahead and refinance, because down the line, you'll be able to recuperate that one way or another. But even though you're alleviating like $200, $300, if you're smart with that money and you put it back down the line, you're going to be able to redo it again. And you're just going to be saving a lot more.
And if any of these predictions about next year are correct, there isn't going to be a massive race to the bottom for rates. It might just march its way down slowly and trickle down, and maybe not even by that much. So